This panel is going to be on markets, and we're going to start with a presentation by GIC's chairman, George Chechekos, ex-dean of the business school at Drexel University in Philadelphia. And then we have two associates from UBS. I'm going to say Stefan's name, then I'm going to let him introduce his partner because he gave me his pronunciation. I can't do it, I'm sorry. I already butchered John's name, so I'm not going to do it again. But so first we'll have a presentation by George, and then maybe 5 minutes from each of our friends from UBS, and then we're going to open it up to questions. So we're just going to have a free-for-all after that, and then we'll all go have a beer.
Thank you. Such a great pleasure to be here, even though I missed yesterday's flight from Philadelphia and I arrived today. But I hope I will stay awake until the end of this session. One of the challenges that we have in our session is that to make you aware of the good things that we want to say after having such a lengthy day with a lot of intellectual discussions and information. So we want to make sure that you also you are engaged and you have an interest, and we will try to have a very interesting panel. From my perspective also, it's very challenging to be the last, to participate in the last session, and the reason for that is because everybody has said whatever I want to say. So my objective here is just to give you a broad overview about the equity markets. I'm not going to talk about the debt markets, with particular emphasis on the global outlook. And if I may, I can start with the notion that after the crisis, really, we are starving for stability. And the crisis in the United States had generated an amplification effect in the European Union and other parts of the world. And from the crisis, we had some policy responses, especially in the United States, but in other parts of the world, that led to some kind of stability, but not really stability. We go through a transition now, and I think the operative word that we need to have in mind is we are trying to reach a new equilibrium as we move from the crisis to stability via a transitional mode of activities. So moving towards a normalized environment, this means for the United States to normalize the monetary policy, which is really, as we know, it has been outside of the box. It's something that in an uncharted territory. We don't know all the consequences of the exit. We do know that we have started exiting. The question is how soon, how fast, how late. I don't have an answer to those questions. I don't pretend that I'm an expert, but I hear from a lot of experts and I'm confused, to be frank with you, and nobody has a clear answer to that. And that's why I think markets, equity markets in particular, and debt markets are quite nervous. With respect to the emerging markets, and we know that different emerging markets, they have a different color on this. They need more balancing. As liquidity has moved away, and I will show you a couple of slides that demonstrate that. And with respect to the Eurozone, yeah, a few years ago, we were thinking that my favorite country, Greece, will be out of the Euro, but it is not. Actually, it's part of the Euro. The Eurozone is still alive. But is the problem away? No, absolutely not. What we have a situation in which there is promise for integration. We have seen some steps, good steps, but the timeline is very long, and we need to see more progress on that. With respect to Japan, from the deflation, we have a reflection now. We are reflecting on the new policies, and we hope that the new policies will work in a way that consumption will increase, in a way that additional GDP will add value to the global output as well. So in this environment, it's not surprising that equity markets are rotational. exhibit volatility, and they are rotational. Rotational means that money is shifting away from one segment of the market to a different segment. And last year, we observed substantial returns on the equity side. But if you look for this year, up to now, the first quarter of 2014, S&P is up only 1.8. The Russell 3000 is very close to 1.7. And for the NASDAQ is less than 1%. Whereas in other categories, for example, USD, oil, and gold, the returns are reported here to be, in a different, not as high as they used to be in the previous year, but in a good territory for the first term. And they run, if you multiply that by 4, they run at very good annualized rates. Global inflation is contained, as is anticipated. So in the horizon, investors do not expect to see inflation, at least for a couple of years. And therefore, the medium-term expectations are such that inflation has been contained. In the United States, the trend is that we have more employment, despite the difficulties of the participation rate that were discussed by one of our speakers here, and the concerns about the participation rates. But the auto sales have rebounded very nicely for this year, and despite the weather in the United States, we expect a boost in the prices based on early surveys coming up from the automakers for the spring and the summer quarter. And the capital expenditures in the United States are really, they're not bad, but they're not spectacular after the crisis have rebounded. Consumption has rebounded, but is not really at a level that demonstrates real growth. It is expected to pick up, but nobody knows, to be frank with you. Different opinions, different views. And in the Eurozone, the recovery is taking place. It's good, it's slow, but it comes from a zero level. The expectation is to be accelerated in the second and the third quarter of this year. In the periphery, and I'm not including Greece, which is very problematic, but in the periphery, if you look on Spain and Italy, you will find out the economic recovery perhaps is robust. At the same time, when the financial instruments provide very low yields for those countries to finance their credit and to finance some of the deficits that they have experienced. In Japan, and we had a previous session in Japan, the expectation, the takeaway from me is that there is an uptick on the GDP and at the same time an increase, a reasonable, very small increase on the CPI index, suggesting that inflation is coming up, which is needed to, for the country to exit from a deflationary environment. Now, where we stand on the business cycle, I mean, we have to observe these trends and these facts in relation to the business cycle. In my view, from the downturn that we observed and the crisis that we observed in 2008, 2009, where the focus on the equity markets were on the defensive growth stocks, such as telecoms, pharmaceuticals, and utilities, we moved to a recovery stage with the early cyclical stocks that included consumer durables and financials. And then now I think we have moved to the mid-cycle with the secular themes and secular growth stocks, which involve the soft tech companies, media, gaming, biotech, and consumer discretionals, hoping that we will exit this phase, move into a higher growth for the economy and a peak in the equity prices. There is growth potential, of course, and good anticipated returns, but the economy needs to pick up for this to take place. So in my view, we are in the mid-cycle phase of the equity market returns. And if I can present an evidence to that, is that if you look on the S&P 500 PE ratio, price earnings ratio, we are just at the historical levels. We are not really very high up, in terms of the long-term averages as those were observed in 96 and 99 or even 2000 and 2001, and which suggests that most likely we will observe increases if the economy picks up. We'll observe more increases in the returns in the equity marketplace. For emerging markets, the big question is what's going to happen to the interest rates in the United States as we exit from the very accommodative monetary policy, and we have observed the volatility. This is a part of an academic work that has been done, and it shows that when you have the spreads between emerging markets and the United States to be high, then there is a flow of capital to the emerging markets. If those spreads diminish, decline, then capital is moving away from the emerging markets back to the developed countries. And at the same time, when there is volatility, very low volatility in the equity markets in the United States, empirically, there is evidence that there is inflows of FDIs, foreign direct investments, and capital flows to emerging markets, whereas when you have low volatility, when you have low volatility, as it is depicted in this graph, then you have flows to the emerging market. But when you have higher volatility, then the flows diminish, which corroborates with the fact that we have observed a big rotation of portfolio investment from emerging markets towards developed markets in the recent months, as this volatility attributed or contributed to this rotational move of portfolios. Still, emerging markets, I think, they are a good opportunity. They offer a good ratio, if you wish, on PEs in relation to the global index. And there is a possibility for more investments of institutional money, primarily towards emerging markets, even though there are some concerns in certain parts of emerging markets. In my view, convertibles, which is a hybrid security between debt and equity, are the ones that in this volatile environment really have very good performance. And this graph shows the percentage of the pricing of convertibles or returns of the convertibles that is attributed to the equity movements in the market. So somehow convertibles in this volatile environment, they behave very well, and they can pick up a larger and larger portion of the equity movements in the marketplace. Now, historically, when we see, and this is technical actually, it's not, it's a technical analysis here, we have seen periods of time from, this is from quite some time, it's 1990s to 2010s. We have seen secular bear markets, we have seen a bull market which has a duration which is significant. The last one, it was in 2010, I think 12 or 13. We have seen some increased activities in the equity market with good returns. The question is, what's going to happen to the stock equity returns if interest rates rise? Now, you know, I wish I knew, so I would be able to be very, very wealthy. But historically, what is happening is not something interesting. When we had rising interest rates in 1993-94, where you would anticipate equity returns to decline, instead the market moved on a sideways, which means that it did not drop, but it maintained the level, the previous level prior to the rise in interest rates. So it was a sideways market. So it might happen again, we don't know. So, but we cannot say always that because of interest rates increases, anticipated rate increases, somehow the market is going to drop. It's a fear. It has been presented in various discussions, but historically this is not accurate. Now, in this environment, however, of rising interest rates, a diversified investor should take into consideration certain sectors of the economy that are anticipated to do well based on the business cycle. And the suggestion here is to look on cyclical sectors that historically perform very well. And these are tech, the materials, energy, industrials, and financials, whereas certain other areas like telecoms, healthcare, utilities do not fare well in a rising interest rate environment. So, concluding, I do believe that volatility is right now, it's a big issue in the equity markets across the world. But at the same time, there's a rotational kind of work that is taking place where funds are rotated within the fixed income component and from the fixed income to the equity component. And we don't know how this is going to continue or whether or not they're going to be back and forth on those rotational activities. But the global outlook, it doesn't look that bad. It might look okay. It's not spectacular. In my view, we should be cautiously optimistic for various reasons. And I think I have written here some of the things with respect to the U.S. economy. I think we know right now the economy is doing okay, not as bad as it used to be a few years ago, but there is an upside potential. In the Eurozone, finally we can see some recovery. We don't know how fast it will be, but the core of the European Union is very strong, whereas the periphery is the issue, and the asymmetries between the core and the periphery might create issues for the entire European Union. For the emerging markets, still they might present a source of growth, given the population and movements and the upper class, development of the middle class, not upper, middle class in certain markets. And I think the big issue globally will be the synchronization of the expansion that we don't know how it's going to happen, how fast will happen, and under what circumstances this is going to generate better returns for the global investor. I wish I had the crystal ball. I hate to say I don't. And to the extent that the panel can provide us very wonderful insights of that, perhaps I can capitalize and put my pension fund in an allocation that will allow me to generate high risk-adjusted returns. And I want to thank you for listening to me. Thank you.
Okay, well, thank you very much. I've been asked to give just a quick introductory remark, about 5 minutes. I'm not sure I will stick to 5 minutes because I used to be an economist, so I tend to be too long. If there is one thing I would like to focus on from a market point of view, because my role is to do asset allocation, so look cross-asset, the key topic for me is central bank and what you were calling the exit strategy. So in the world, you have several central banks, obviously. At one end, I would put the Fed, which is close to the exit, actually started to exit if you think about April. And at the other end, you would have Japan, where we think you will have more QE, or the ECB. I don't know if you saw the speech by Draghi this afternoon, but it looks like it's signaling a rate cut. Why is that important is because what we have seen in the US last year is a big steepening of the curve, which is typical in the early phase of the cycle. The curve starts to price the recovery. The short part does not move because the central bank does not react. We're moving to a more mature phase of the cycle, which is a flattening of the curve because the central bank react or start to signal that it will react. And just to give you a couple of numbers, if you look at the 210, so the steepness of the curve between the 2-year and the 10-year, we were at 260 basis points at the end of last year, almost, which is very close to the all-time high. We're now at 220, a little bit below. So you've started to see the curve flattening. And it's not only that, it's also the forward are telling you the curve will continue to flatten. So the 1 year future on the 210 was at 10 basis points. So the curve was telling you I will flatten by 10 basis points at the beginning of the year. Now it's telling you 30, 40 basis points. So not only you're moving to phase 2 with the flattening, but the curve is telling you I will continue to flatten, and I will flatten faster than I was telling you a few months ago. So I do think we're moving to the second phase of the cycle. Now, that's all in well. I explained you the past, which is reasonably easy. The second point I would like to make is that the UBS view is much more aggressive than what is priced in terms of the Fed. We think the Fed is likely to move faster than what is priced by the market right now. And let me run you through a couple of arguments. The first one is, if you look at the Fed guidance, so you know we have all the detail of where the Fed fund will be. And if you look at the Fed forecast, you take the Fed forecast, you dump that in a Taylor rule, you would actually have a much earlier rate hike and a much faster one. So basically, the Fed does not agree with itself, in a sense. If they really believe their forecast, they should hike higher, faster. I can easily buy the argument that they're going to be late because there's so much uncertainty about the narrow, the output gap, and because they want to be sure that there's a recovery. But when they start to hike, I think they're going to be very quick. If you look at the forward guidance, they say we start hiking and then we do 25, pause, 25, pause. I think that's very unlikely. I think when they start, they're going to do 25, 25. So you're going to have a very quick adjustment. Second argument that we're using is, you were talking about CapEx. We actually, that's another place where we are different from the consensus. Maury Harris, our US economist, is bullish on CapEx this year, and I can run you through the argument afterwards. I run a regression model, Fed funds versus CapEx, and Fed funds versus GDP. And you have a higher correlation with CapEx, which intuitively makes sense, because when you have a recovery, it might be due to export, to CapEx, to inventory. The Fed does not react immediately. They want to make sure there is a recovery. When you have CapEx, it means that it's a solid recovery, it's a self-sustained recovery, and then the Fed knows they can go. So the point here is, if we're right on the numbers, if you really see CapEx picking up, it's going to be very difficult for Janet Yellen to tell you, oh, it's a weak recovery, I cannot do anything, and etc. And the curve will start to price. Last point I would like to make is inflation. I mean, we were talking with Banu about that. I think inflation is a key topic for me. And on inflation, just 2 data points. First one, we at UBS run a surprise index. So every day, when I say we, it's not me, it's the economists actually, they do that. Every day they look at the economic data and look whether they're better or worse than the Bloomberg consensus. So we have a growth index, inflation index. The inflation index is actually picking up. So if you look at the past 2 years, it's a total catastrophe. The index was going down and down, so that means that the vast majority of inflation data were below expectation. Over the past 5 to 6 months, it's picking up, and is essentially a US story. If now I look at the flow of funds, we saw a lot of flow in ETF into fixed income, but a lot of outflow in linkers. So basically, the data are better than expected or higher than expected. So you should start to say, oh my God, there is something maybe moving in inflation. And the market tells me, I don't care, Stefan, I don't want to buy protection. I'm actually selling my protection on inflation. The point I'm making here is, if this continue, and it's a big if, arguably, you could also have some pressure on the Fed. So long story short, we think that the risk is that at some point in the near future, the curve start to price much more rate hike. And just to be precise, if you look, for instance, at the 2-5 year, typically the 5-year price all the rate hike of the cycle. The 2 year is much more correlated with the short date, I mean, is the movement in 1.5 years. So one of the trade we like is the 2-5 in 1 year, because the 2-5 should flatten a lot when you start to get close to the thing. So anyway, that was my second point, is we think the flattening will continue and faster. Why I am so obsessed by that is because we think the short part of the curve is driving a lot of asset class, much more than long part of the curve. I'll give you one example. If you look at the exchange rate I look at the euro dollar and the correlation with the 10-year, 5-year, 7, 5-year, 2-year, etc. The euro dollar is much more correlated with the short part of the curve. So if I give you a big steepening of the curve, the 10-year moving and the short part not moving, the euro dollar is not impacted much. If we are right that the short part start to move more, then the euro dollar would move. And Banu would probably tell you the same thing for EM currency and etc. So what I'm telling you is we're entering a very different phase of the cycle in terms of the pattern of assets. That's also a story which is more difficult for equity. So I was interested with your chart on rates and etc. I did the same thing. If you look at the 11 episode of rate hike from the Fed, we have 11 episodes since the Second World War. On average, the year that followed the first rate hike, the S&P is up 10%, 9.4 to be precise. Why? Because if the Fed hike is because there is recovery and that's what dominates. But actually, if I tell you 9.4, it's a lie. Why? Because the spread is between -10 and +30% for the performance. So if I tell you my forecast this year is between -10 and +30%, you say, yeah, thank you very much. So what you really have to explain is why sometimes the market likes it a lot and sometimes it doesn't like it. And what I found is simple, is the starting point is the key topic. So if you start from a very, very low Fed fund, the stock market rally a lot. Because if you have a very low Fed fund, you probably come from a very nasty recession with deflation and etc. The Fed hike, it means you're out of the wood. The two negative episodes are the episode where the Fed funds were already above 5% at the beginning of the cycle. That's the Volcker period, where you have too much inflation, too much volatility. The Fed is going very aggressively, and the stock market doesn't like it. The point I'm making is, and is exactly what you find, is the correlation is not constant between rate and equity. But my point is, I think we're probably much closer to the low rate environment. So I don't expect a big rally in equity, but in our central case scenario, you should get a 10-ish% in equity. So not great, but that's the last point I would like to make is volatility. You were talking about the pickup in volatility. That's one point for me, which is really, really important for market. If the short part of the curve move, that's volatility in the money market. And because the money market is a reference point for the pricing of other market, the volatility in the money market contaminates the volatility in other markets. And we test that. Statistically, you find very good T-stat and correlation with a lag. So when the volatility on the money market moves, you see the swaption vol on all the curve moving, you see the currency vol moving, you see the VIX moving, and et cetera, et cetera. So what I'm getting at here is I think your remark on vol is very important, and I think vol will continue to go up. And that, again, so don't shoot the messenger, because I told you the equity rally will not be great, and on top of that, you will have to pay with more volatility. But I think it has a lot of implication for other asset class also. The carry trade was very, very fashionable in a number of assets. When you have a low vol, carry trade is fantastic. You're king of the world. You have the carry and no risk. When the vol pick up, all of a sudden, a lot of the carry trade looks much less attractive. So for me, it's a little bit the flip side of the coin. So you see, the bottom line for me is, A, I think we move from phase 1 to phase 2 of the cycle. So after the steepening, you have the flattening, and it's starting already. B, I think if our central case scenario, if our economists are right, the short part of the curve will continue to move and probably faster than what is expected by the market, so even more flattening. And C, and that's the most important part, is not only a story for fixed income investor who will punt on the 2-5-year flattening forward in 1 year. It has a lot of implication for the performance of other asset class and the behavior of asset class. I don't know if I did 5 minutes or more, I assume more, but I'm done, don't worry. I leave the floor to Banu now.
Thanks very much, Stefan. Thanks everyone for listening. My name is Banu Baveja. The moderator didn't want to take a risk with my name, but I can promise you, as Indian names go, this is sort of a 101 name, right? It's a very simple name. I do cross-asset strategy for emerging markets. And some really interesting comments out here. I mean, the one thing I will say about EM is that Today, a lot of people are concerned about EM, so in their minds, they're quite bearish on EM, but on their books, they aren't. Right? So you've seen people become reasonably concerned about China, people quite concerned about Brazil, but if you look at the flows into emerging markets, as I think your chart showed, it's a simple inverse correlation with volatility, and volatility is very, very low right now, and it's low by policy design. You know, the Fed has gone out and killed every wall buyer by policy design. You want to bring down real interest rates, you want to flatten the curve at zero, and you want to keep vol very, very low because you want financial conditions very loose. That's a great world for emerging markets, and that's why you've seen continued flows into EM. So the big sudden stop that we are used to in EM, that we've seen in the 1980s, that we saw during the tequila crisis in Mexico in 1994, and then during the Asian crisis, followed by Brazil, Russia, and Turkey, we just haven't seen that. And there's a good reason why we haven't seen that. As I said, the Fed funds matters a lot because it has kept vol very, very low, but EM itself has grown up. And the most important way in which emerging markets have grown up is that they have refinanced their dollar debt in local currency terms. So in the 1990s, in the 1980s, your entire debt was controlled by the London Club, by the Paris Club, by the IMF, because all of your credit cycle was entirely driven by dollar bonds. I don't know how many of you remember Brady bonds. That's all gone. Today, people want to invest in the Polish zloty. They want to buy bonds in Mexico. They want to buy bonds in China in local currency terms. And that's why the FX risk in EM sits with you folks. It doesn't sit with the investors, or it doesn't sit with the corporates, I should say, in emerging markets. That's one respect, an important respect, in which emerging markets have grown up. And that's why it's very unlikely that emerging markets will completely blow, right? Because when we speak about blow-ups, how do we predict blow-ups in global financial markets? Well, there are 3 or 4 variables that count. Number one, change in credit to GDP, leverage, right? And there's plenty of that in EM. EM has levered itself up. Number 2, current accounts. They have deteriorated in EM. You still have large surpluses in the Middle East. You have a nice surplus even today, although much smaller in China. But overall, you see much larger current account deficits and much lower current account surpluses. But number 3, you speak about short-term debt relative to reserves, and that's where EM's strength is. For a big blow-up in EM, you need a liability problem, and EM does not have a liability problem. I'm making a very general comment. There's this funky EM as well. There's Ukraine, and there's Venezuela, and there's Argentina, but that's a small part of EM, right? Mainstream EM, for those of you who are equity investors, China, Korea, Taiwan, the reason they're unlikely to blow up is because you don't have a liability problem. Now, what I'm effectively saying to you is that EM's balance sheet is fine. If an entity's balance sheet's fine, you feel reasonably happy to lend your money to them because you think these guys are going to service their principal on time, and these guys will probably give me back my coupon on time as well. So you feel happy buying their debt. But, and this is where the problem for EM begins, EM's completely lost its growth mojo. Its growth model is broken because its entire growth model was based very largely on one variable, which was exports. And exports is exactly where emerging markets have been in severe recession for the last 3 years. We haven't felt it because emerging markets have compensated for it by a massive increase in credit. So there are 2 cylinders that EM has been running on before the crisis, which is exports and credit, and after the crisis, it's just been 1 cylinder which has been running in overdrive, which is credit, which is why China's credit to GDP currently sits at 240%. So what do we do in this world where EM's lost its growth model, but it doesn't have a big liabilities problem? For those of you who are interested in the asset allocation call between EM debt and EM equity, over the long haul, over the next 3 to 4 years, I would say to you that's still a debt trade over an equity trade. That's not what we are saying about the developed markets, because we think in DM we can get more equity, more juice out of equity than we can get out of debt. But in emerging markets, EM debt over the next 3 years, I think will give you better Sharpe ratio returns compared to EM equities. And there's a view out there that EM equities have reached levels which are dirt cheap. And I'd warn you against that view, because The distribution of EM equities is so varied. The dispersion, the range, the standard deviation, whatever, is so high that you don't trust the mean valuation. You have consumer staples at 25 times, and you have materials which are trading at 5 times. So it's very difficult to say that EM equities are trading at 14 times and that's cheap. If you think EM equities are cheap, you're really making a very specific sector call and very specific market call. If you think EM equities are cheap, you're buying energy, you're buying financials, and you're buying materials. If you think EM equities are cheap, you're buying China, Korea, and Russia. Outside of these sectors and outside of these markets, EM equities are not cheap. What you can't do is say, EM equities are cheap, I'm going to help myself to some Indian consumer or South African banks. That doesn't work, because they are not cheap. So I think the headline level of PE at EM is slightly deceptive. You really have to go into individual sectors. That's point one. Point two, you've got to pray and hope that the export rebound comes through, because the single most important variable in deciding earnings growth in EM is exports, and that's where the big downside for EM has been. And our view, which is not in line with consensus, is that even as the US recovers and Europe recovers, we are unlikely to see a big recovery in EM exports. And the reason I think that's happening is because the beta between global trade, between global growth, I should say, and global trade is weakening. Between the 1980s until about 2007, for every 1 unit of global growth, you got about 3 units of global trade. So trade as a percentage of global output was rising, which in simple terms means that the world was getting more and more globalized. I'm not calling for a collapse in globalization or a massive rise in protectionism or world war or the Archduke in Hungary getting shot. I'm not talking about all of that, but I am saying that the gains from globalization seem to be peaking, that the relationship between global growth and global trade, which used to be 1 to 3, might move to 1 to 2 or 1 to 1.5. And that makes all the difference for EM equity earnings, because it means that as US grows at 2.5%, EM exports grow at, instead of 15%, 8%, which means your trend growth in EM earnings is much, much lower. And that's why I think if there's a structural issue, it is in EM equities, not so much in EM debt, although today the debt trade is a much more crowded trade. China is an absolute, it's a very, very important call. As I said to you, we're not looking for a collapse in China, but China will have to pay its pound of flesh in the form of much, much lower growth. In fact, if you think about EM's NPV over the last 10, 15 years, the 2 most important drivers of emerging market assets have been, number one, the decline in US real rates. In fact, that has touched every asset in the world, emerging or non-emerging. So the real risk-free rate coming lower. And number 2, it's the rise of China. If you have a simplistic mind, and I certainly do, I think of it as the relative call between the Chinese property market and the US property market after the crisis. As the Chinese property market has done very well, Brazil, Chile, Australia, Indonesia have all been selling their wares to China. And as the US property market has done badly, the risk-free rate most recently has come off. If you now believe, as we do, that slowly but steadily the Chinese property market will plateau out and the US property market will recover, your call on EM NPV completely changes, because your numerator, which is China, is getting compressed, and your denominator, which is the discount rate, Fed rate, 5-year, 5-year, or 10-year rate, is going to go up. That's why EM's NPV is compromised. But back on China, what China does not have is a liability problem. Unlike Spain pre-crisis, unlike Hungary pre-crisis, although your credit to GDP has gone up, your loans to deposit has not, which is a funky way of saying you're levered, but you're financing it yourself, right? Very Japan-esque. What that means is that, very similar to Japan, you are unlikely to completely blow up. Your property market can get hurt, but you're not likely to see a balance of payments crisis. What you are likely to see is that your import propensity falls. Growth estimates, which are currently at 7.5%, are very quickly revised down towards 6%, maybe even lower than that. Who's in harm's way from that? Surely China itself, but I think it is largely priced into Chinese assets. Where it's not priced is in Brazil, is in Chile, is in Australia. These are the places where you're in harm's way if China really goes down that path. Although, once again, I want to reiterate that if you're looking for a 1980s kind of crisis in EM, I think you'll be waiting a very, very long time. I don't think that's happening because, quite simply, there isn't, as I said, a liabilities problem, right? So I've made a few simple points. Today, EM equities do look cheap, but you really have to make a sector-specific call. And based on what I said to you about China, we certainly don't like materials just yet, even though they have cheapened relative to history. Number two, there's a crucial break in the relationship between global trade and global growth. And I think that's material for EM exports, which in turn is material for EM equities and also for EM currencies. We are bullish on the dollar versus EM currencies. This year, being short emerging markets has been very painful for many asset managers because the two main trends this year to date, have been the decline in vol across all asset classes and the decline in the long end US rate, especially the 30-year. The question is, does the 30-year know something that we don't? Is it possible that we're all long equities, short fixed income, and the US rate therefore and then goes to 2.2%? The pain trade is still lower US yields. In that sort of a world, EM debt does well, but EM equities get hurt quite badly because that's a world in which we start worrying about deflation once again. So again, where I'm going with all of this is that you should expect much lower returns from EM in the future relative to what you've done pre-crisis. But within that, I think the Sharpe ratio over the long haul from EM would be better in debt than in equity. I think equity is a more fundamentally compromised asset class. EM's heyday was 2007, when we were all bemoaning global imbalances. The truth is, and this is EM's dirty secret, global imbalances were great for EM. The global economy was on steroids, and EM was providing those steroids. So MSCI EM peaked in 2007. MB spreads, which is your credit, troughed in 2007. EM currencies peaked in 2007. If the world is rebalancing, that's great for a 10-year view, but it's horrible for EM. What would be good is if EM found organic growth through reform. And I can promise you, even if I'm very, very generous, there are about 3 or 4 markets in EM which are reformist. So EM, let's not blame EM. No one does reform unless you're forced to. And certainly where global yields are, no one is being forced to do reform right now. Bottom line, EM has no balance sheet problem, but EM has a very severe and persistent income statement problem. In that sort of a world, EM equities and EM FX are not your asset classes for the long haul, but you should be a buyer of EM debt on dips, much as it is a very crowded asset class. I apologize, our PowerPoint machine didn't seem to work at UBS, and neither Steph nor I have any PowerPoint slides, but we thought we'll take it easy on you guys. You've suffered the whole day through a series of presentations, so I'm going to leave it out there.
So I want to thank the panel very much. I think you're better without slides. That was a great presentation. I'm going to take the moderator's prerogative here and ask a question. I'm a commodities guy, so I'm not into stocks and bonds so much. But what I hear you saying is that there's going to be a rotation where the emerging markets aren't going to be doing so well, and that the developed world is seeing some comeback. And that even in the emerging markets, because this goes back to what John was saying about China and what I believe about China, that it's going to be their service industries that are doing better. So as a commodities guy, my number one thing that comes out of that is energy's in a lot of trouble because you're circulating away from a manufacturing-driven base towards a more service-oriented base. You throw in Iran may have oil coming back to the market. You throw in Japan may bring nukes back on. There's a lot of downside risk in energy. What is your view on that?
Look, I don't completely disagree. The only thing I would say is that the futures curve is kind of pricing that in. Perhaps it's not pricing it enough, but the curve is nicely inverted, and the standard deviation of the curve has fallen relative to history. In other words, you think rates are going to go lower, and you trust your forecast much more than you used to in history. Do I feel that I want to sell oil beyond what the futures are already pricing in? At the margin, yes. But given what's priced into the futures, I think it becomes a marginal call, especially because we don't understand the geopolitics of what's going to happen in the Middle East as well. The relationship between Russia and Iran, for instance. But broadly, I completely agree with the thesis. The only thing I will say is that I think the more elegant expression of a China slowdown lies not so much in energy, but in industrial metals. Iron ore and copper, I think, have still further to come down. And so between different asset classes or between different commodities, the way we would think about it is our number one short or our number one dislike would be on industrial, followed by energy, followed by precious, and lastly, agriculture. And so soft commodities, we wouldn't be that bearish on, but perhaps Steph has to add something.
No, I fully agree. I mean, I think your remark on oil can be generated more broadly on most of the commodities. To make it very simple, I think the super cycle in commodity is over, from my point of view. So you end up with an asset class which is not really pleasant for an asset allocator like me, because we're talking about low return, potentially, and very high volatility. Usually you like the opposite. And to be fair, we tried to play this asset class several times, playing the restocking cycle, destocking cycle. You have to be a specialist. You should not talk to me because I'm a generalist. You should talk to a guy who's with his nose on the Bloomberg screen all the day, and he will tell you be long copper for 3 days, be short iron ore, and etc. So the way I look at this asset class is implicitly what Banu was saying is, instead of trying to forecast it, I try to extract the signal from the asset class. And the iron ore story is very important because, just to give you two numbers, more than half of iron ore is consumed by China. If you look at the housing market, that accounts for more than 60% of the consumption of China. So the bottom line is there's a little correlation between the price in iron ore and housing. If you look at the price of iron ore since the beginning of the year, it's very, very worrying. So actually, I'm more looking at commodity that way as an early signal of the cycle of some sector and etc., rather than trying to do the other way, because honestly speaking, I think the asset class in general has lost a lot of attractiveness for people like me who are generalists, because I don't think you can generate a lot of return from this asset class.
We have questions from the audience? Don Rismiller?
So in the equity space, we've seen a rotation from growth to value that seems to have keyed on the Fed meeting day back a couple months ago when Janet Yellen gave her press conference. Yet at that press conference, she went to enormous lengths to say there's no change in policy. Does anyone have any good explanations for why that occurred in that fashion, why that was the transition recently from growth to value?
I mean, these are reactions based on interpretation of investors, I guess. I mean, I can give you a generic kind of answer, but at the same time, I mean, those statements coming from the Fed have been always confusing, especially when you have others participating in those discussions. So eventually everybody's getting nervous because everybody knows, especially in the United States, that we have to exit. We don't know how to do it, and then the more you hear about noise, the more you become value conscious, and this explains perhaps the rotation. And we will see more volatility on that. I mean, I don't think we have seen whatever. I mean, yesterday, Yellen said something, the market is up 120 points. The previous day, another announcement on the economy, the market was down 140. If you look on the micro level and in the very short term, I mean, volatility is picking up. I hope you agree with me on the volatility aspect.
Yeah, broadly, I mean, I do agree with that, but just in response to your question, I don't think it was only equities. The market disagreed with some of the thrust that, especially after her 6-month comment, the market disagreed also in fixed income, because the reaction in the fixed income market and the equity market was very consistent. It was a reaction which said, growth is improving, rates are going to go up, let's buy value rather than growth. And because the front end got paid up after Yellen, and she was at pains to explain herself later, but I think the cat was out of the bag when she said recovery is improving and we'll hike 6 months after we stop tapering. So the front end got paid up, and the reaction from the equity market was very consistent. So I don't really see it as an isolated sort of aberration. It was, now whether the market's right on that is a different question, right? I mean, it's very possible that Yellen just keeps saying, look, the labor market's just not improving and the housing market's flattening out, so in fact we're going to hike first in 2016. I mean, in that sort of a situation, we'll come back. But I thought the reaction was not strange, it was consistent with the fixed income market.
Hi, I just want to ask a question on volatility, which has been a current theme amongst all three of you. We had a period over the last couple of years where we had a difference between implied and realized volatility. And I remember a period where back in January, implied volatility was a lot higher than what we actually experienced in the third quarter of, let's say, 2012 or periods like that. Especially for the UBS guys, how's your house view on implied volatility for the rest of the year, given we've got the elections in the US and some of this geopolitical risk that's priced in at the moment? And maybe you can explain a bit more on that.
Maybe one point I would like to make is a lot of people look at the VIX as a proxy of volatility. Just to remind you, the VIX is an average of option with the 1 month duration. So when investors say the volatility is extremely low, look at the VIX, yes, and you can buy protection, which is very cheap, but you're not very well protected because you're protected only for 1 month. If you look at the slope of the volatility, it's very, very steep. It's unusually steep. So actually, if you want to buy proper protection, like for 3 months or 6 months, it's much more expensive. And it's expensive because you have a very big negative carry trade. So if you buy protection on 6 months, the price is very high and will go down because the theta is important. So I think that's one point you have to keep in mind is the market is telling you, I'm not worried about the near future, but on the medium term, volatility is still high. We did some research on that, and actually what you find is volatility is also very correlated with the volume in the market. And we think that one of the reasons that the implied volatility was so low is also because the trading is at, in terms of volume, is still at a very, very low level. If we do have more of a recovery, more historical volatility, you should see more volume in trading, and so you should see the implied volatility also picking up little by little. So, but I think that my answer is very much on the diagnosis, which is volatility is low. It is in a number of cases. In FX, for instance, it's rock bottom. But I think you have to be a little bit cautious with this kind of argument because the long-dated volatility is not that low, actually.
Yeah, and just to add a little bit to what Stefan says, and I totally agree with him, I think it's important to try and isolate. It's not very easy, but try and isolate what is the driver of lower vol. Which asset class has really taken vol considerably lower? And I think in this sort of year to date, it is bond vol that has driven vol everywhere else lower, and particularly at the long end. Because money market vol, if you look at very short-dated swaptions, their vol is actually still quite high. But if you look at long-dated vol, on 10-year paper, for instance, or 10-year swaps, it's come off a long way. So it's the 30-year move, it's the 10-year move that has driven vol in every asset class considerably lower. If that's correct, then it stands to reason that to forecast vol higher, we must be looking for higher bond vol, which, by the way, is already at a very low level. Let me give you some context. Bond vol currently is lower, long end bond vol currently is lower than it was just before the taper talk began last May. So it's given back all of its gains since last May. The big call in the US, and this is entirely Stefan's territory, I'll just give you my ill-informed view, is US inflation. It seems to me that there's a very broad consensus emerging within investors that US inflation is going absolutely nowhere. And that's one of the reasons why we are seeing this duration rally as people are stopping out of their short duration positions. If that view turns out to be wrong, even modestly wrong, That, I think, is one of the biggest drivers of vol this year, and it seems to me very plausible, certainly based on what our economists are saying.
So I want to make sure I get the message right. Is it that Chairwoman Yellen misspoke when she said 6 months, or misspoke when she retracted the firmness of that 6 months? That's one question. And the second question, we heard reference to the internal inconsistency of the Federal Reserve's own forecast. And so I'd be interested in knowing where those inconsistencies lie.
Okay. On the 6 months, I give you the house view. Oops. So the house view on tapering is what you will hear from everybody, which is 10 billion in each meeting, so you continue like that, and you get to zero at the end of the year. We think the first rate hike comes in Q2. So we think she will do 6 months, more or less. That's the order of magnitude. Sorry? Simply because we think, that goes back to the second part of your question, we more or less agree with the economic forecast of the Fed. So we think the economy will be growing at more than 3% on a sequential basis during the second half of the year. We think you have job creation. My CapEx argument, I think, is very important, also because that tells you solid recovery and etc. And the inflation argument, which Banu underlined, is also important. So you end up in a situation, I mean, 6 months is far, far away. You know, we're talking about 1 year from now. So you would be with an economy which is growing and which is out of deflation. The deflation fear would go down to not zero probability, but very, very low. So you're in a situation where you have to act, basically. When I was saying the Fed is inconsistent is because if you take their own forecast on inflation or on output gap, etc., you dump that on the Taylor rule, you end up with a different path, which is much earlier. But to be honest, sorry? Yes. To be honest, again, there's so much uncertainty about the Nehru. I mean, if you talk to Yellen, she will tell you 4.5%. If you talk to Plausen or Fisher, they will say 6.5. No. The problem is that there's a huge uncertainty. So if I'm the Fed, I don't want to hike immediately. I want to make sure there's recovery. So I can very easily buy the argument that they will be late. And when I say late, it is not a critic. I'm not saying it's a wrong policy decision. But the point of view we have is you cannot be late and slow at the same time. So when you start, if you're late, it's because you have the burden of proof is there, you have enough evidence, and then you have to neutralize rate. By the way, we have our own Taylor rule, but there is a working paper from the San Francisco Fed where they do a Taylor rule adjusted for QE. And so basically, because you have all this liquidity in the system, that's akin to a rate cut, so you have to compensate for that. If you use this Taylor rule, you have 9% on Fed fund at the end of next year. Now, it's not my forecast. Don't walk away saying he's expecting 9%. But I think that's also an interesting point, because if really we are right and you go to a 3% trend growth and inflation is starting to creep up little by little, if the Fed wants to withdraw liquidity, it's not with Fed fund at 50 basis point or 75 basis point that they will withdraw this liquidity. They will probably have to go faster than normal. So you see, the argument is not really, I'm not really disputing the 6 months. I think it's more or less the order of magnitude we have in the back of our mind. But what I'm disputing is afterwards, the stuff will go much, much faster than they say. That's why the 2.5 should move a lot, because the 5 is already moving, already pricing all the rate hikes, so you're already at the top. And the 2 is saying we're not moving. So when we start moving, the 2 will shoot up very, very, very quickly. I don't know if that's better, I think.
Well, ladies and gentlemen, we started with Dave Altig and we've ended with Dave Altig. So I think that's a great, we've had a wonderful conference. Jill is waving at me. There are surveys inside your little booklets. The more of those we can get responded to, the happier we are. So please take a couple minutes and fill that out. I'd like to thank our final panel. Had a wonderful day, and I hope that we'll be able to make this conference in London a regular event for GIC. I think we've had a good start, and we'd like to build on that. Thank you all for coming. I would be remiss as the Vice Chair of Programs if I didn't point out that we have a meeting on May 19th in New York on ETFs. We have a meeting at Jackson Hole on July 11th, and that will feature 3 Fed presidents. And then we're working on conferences in New York, Canada, and Korea for the end of this year, and Spain next spring. If you go to www.interdependence.com, you can keep up to date, and we hope that you'll be able to attend in the future. Thank you very much.